Okay, we're going to talk about something today that is very near and dear to my heart. That is hard money lending. And you might be like, why are you so excited about that? Actually, before I tell you why, this can be a very helpful tool if you're curious about getting into real estate investing personally, or if you have funds sitting on the sideline that maybe you don't want to be exposed to public markets right now, but you're still looking for a substantial return that's relatively low risk. As an investor, this can be a very good path for getting that done. So, what is hard money? It's essentially a short-term loan that is backed by the real estate. And really what you're underwriting as the investor or the one giving the loan is the real estate itself. It's not so much the borrower. We're not taking pay stubs or bank statements or pulling credit necessarily. What you're looking at is, does this deal make sense regardless of who is doing the real estate deal? And hard money loans typically come from private individuals. There are some companies that do this at scale, but more often than not, it's someone who has maybe a self-directed IRA or funds sitting around that aren't actively in the market, and they use those to lend to borrowers who are doing real estate deals for short-term loans. So you're not having to work with what can often be a pain of a process with large banking institutions, mortgage companies, or even, lenders that have 45-day processes for trying to get a loan approved. So just as for example, let's say you found a great real estate deal that you're wanting to move on quickly because you don't want the seller to find another buyer instead of you, and maybe you don't have access to the funds in 2 or 3 weeks and you've got to borrow money. Well, you can't really get a traditional bank or mortgage company to move that quickly. This is where you'd go get hard money to do the deal and then either, buy it, fix it, sell it to recover both your investment and then your profit, or buy it, fix it, refinance, take the hard money off of the deal and hold it for the long term if you're holding it as a rental property. So why do borrowers like hard money loans? 3 reasons. One we just sort of touched on, which is speed. It just moves much quicker than traditional mortgage companies or banks might. The second reason is the flexibility. Most large lending institutions have sort of the box that you have to fit into in order to do the deal or buy the property. So if you have something that doesn't quite fit in that box for any number of reasons, or maybe you as the borrower don't fit into the box, flexibility is going to be an important thing. And then the last thing that would be important is just opportunity. Again, if you've got to move quickly or you need specific things to take place at specific periods of time that just aren't going to work or won't get done by traditional lending institutions, and you miss the deal, and you could have made the deal work if you could just get the money in time and in place, then again, hard money becomes something that's really important to borrowers and investors when they find an opportunity on a great deal and want to move quickly. Now, on the flip side of the coin, for potential lenders, so we've talked about as a borrower why you might want to use hard money, but for a lender, you may have funds sitting around that aren't doing anything, and you may say, well, this is a great opportunity to earn a return with relatively little risk and have a better night's sleep than if that money is in the stock market oftentimes, because the returns are typically between 8 and 14% is what I see in the marketplace, and then you'll see between 1 and 3 points. And when we say point, we just mean percent. So 1 point equals 1% of the loan amount. So on a $200,000 loan amount, 1 point represents $2,000. 3 points represents $6,000. So that's what we mean when we say points. Additionally, the timeline for the money being returned is usually from 6 to 12 months. I've seen hard money loans, slightly shorter timelines, occasionally hard money loans, slightly longer timelines. 80% of the time though, they fall into this 6 to 12 month range, which as a lender, usually people like, because my money goes out, it earns a return, and then it comes back in, and on a deal by deal basis, I'm looking to make future hard money loans. So 3 things if you're a lender looking to do hard money loans is 1, you got to make sure you secure the money with a good asset. So make sure that the property, the real estate is right. 2, you want to be lending it to good people who do what they say they're going to do. Even though we're not doing traditional underwriting on income statements, bank statements, credit reports, you still want to make sure that you're lending it to somebody who is going to ensure you get repaid. And then the third thing is that you just want to make sure you have a good exit strategy. And by that I mean, have a plan A, a plan B, and a plan C. Plan A may be to sell it. If that doesn't go well, then what's the plan? Plan B may be to rent it. If that doesn't go well, then what's the plan? Plan C may be to, turn it into a short-term rental. Who knows? Point being, you want to make sure you have multiple paths to be paid back. I do these type of loans. So if you're the person that's involved in real estate investing and stumble upon a deal where you're looking for funds to get to the finish line for that deal, let me know. We'll take a look at it. And as is the case with anything, there are downsides to hard money loans. So what should you be looking out for as the borrower? Those things would be rates are higher than if you were to go to a bank, obviously. The terms are typically shorter. We said 6 to 12 month balloon on the loan. And basically that means the loan comes due at 6 months or 12 months or 18 months, whatever you and the lender agree upon, which leads to the third thing. If you can't sell it by then, or you can't pay off the loan by then, the lender has the ability to foreclose and take back the property because it is the collateral for the loan. And for lenders, really the risk is similar, but the opposite side of the coin. So it's an illiquid investment. Once you have lent it to the borrower to buy the property, you can't get it back without them selling the property. So it's illiquid. If things go wrong with that borrower, hopefully it's not your neighbor, cousin, whatever, because it's going to be a little bit awkward if you have to take the property back. So make sure you have a good plan in place and you need an agreement in writing that everybody understands what is happening. And then the other thing is just that, again, if things go poorly, you may have to foreclose, which isn't going to be fun for anybody. A, B, that costs money. You've got to get attorneys involved. It takes time, it takes energy. So that would be sort of the downside of being the lender or things to know about if you're going to do this. So to close, you see where, hard money loans can be good for borrowers looking to do real estate investment deals and can be good for individuals, investors looking to lend out their money privately on what is otherwise a very safe and secure and sound investment as long as you do your due diligence. So on either side of the coin, if you're looking to do investment deals and you're looking for money, would love to have a conversation. Vice versa, if you have money and it's sitting in a CD at 4.25% and you think, wow, that was fun for a year, but maybe we should start to look at a little bit more dynamic return, 8, 10, 12% with very low risk. Again, would love to have a conversation because there is a way to do that and do it securely and safely. Hope this was helpful. Feel free to call or email with any questions or to have a conversation, 904-405-1995, and that's Jeff at pursuitrealestate.com. Take care.